Welcome back to the deep dive. Looks like we're diving into investing in the stock market today. Got some really interesting sources for this one. Even found a podcast episode about investing, entirely in Spanish. Don't worry though, we'll break down all the key insights for you.
That's right. We've got a lot to cover. Everything from the basics to some pretty advanced strategies, like splits, IPOs, and even the dogs of the DOW approach. Pretty interesting stuff.
Yeah, I'm excited to dig into that. It seems like every source we've got really emphasizes the importance of learning before jumping into the market. It's not about chasing quick cash, it's more about building a solid foundation. What stands out to you about that?
Well, investing, it's a marathon, not a sprint. So many people jump in without really understanding what's going on, and that can lead to some pretty costly mistakes.
Yeah, I can see that. One source even said to only invest money you've saved, not money you need right away. Seems simple, but it's a really powerful piece of advice.
Absolutely. It's about keeping a cool head. Investing should be about building a secure future, not putting your present at risk.
All right, makes sense.
Your main goal should always be preserving your capital, beating inflation, and achieving consistent growth. Dipping into emergency funds, that's a recipe for disaster.
Speaking of getting started, I loved that tip about using demo accounts, like a flight simulator for investors.
Exactly. Practice makes perfect. Especially with something as complex as the stock market, demo accounts let you test strategies, different platforms, without risking real money.
That's a great way to build confidence before you use real money.
Right.
So let's talk about what happens when you buy a stock. We hear about the stock market all the time, but what is it really?
Well, at its core, the stock market is basically a platform where you're buying and selling pieces of companies. Those pieces are called shares. When you buy a share, you become a part owner, just like that.
So like owning a slice of the pie.
Exactly.
And that ownership comes with certain rights, like getting a portion of the company's profits through dividends.
That's right. Dividends are payments made by companies to their shareholders, usually from their earnings. It's their way of rewarding investors for owning a piece of the business.
Interesting to think that these stock markets exist all over the world. You've got the New York Stock Exchange, of course, but also the Madrid Stock Exchange, Tokyo Stock Exchange, so many others.
It's a truly global marketplace, connecting investors from all corners of the world. And within this marketplace, there's a huge variety of financial products to choose from.
Yeah, you shared a source that really highlighted that variety. We've got the basics, stocks and ETFs.
Stocks, as we've said, represent ownership in a single company. ETFs, or exchange-traded funds, are a bit different. They track a whole basket of assets like a specific index, a commodity, or a sector.
It's amazing how ETFs are becoming so popular these days. Why do you think that's happening?
Well, I think it's because they're flexible, transparent, and they often have lower fees than other options. ETFs offer investors a straightforward way to diversify their portfolios. For example, you could have a Bitcoin ETF that tracks the price of Bitcoin. That lets you get exposure to the crypto market without directly owning Bitcoin itself.
Right, that makes sense. The source material also mentioned derivatives, but warned that they're complex.
Yeah, derivatives are best left to more experienced investors. It's not just buying or selling an asset, it's more like betting on the future price of something. That can be really powerful, but it comes with a higher level of risk.
Some examples they listed were futures, CFDs, options, and warrants.
Each one has its own set of rules and strategies.
Sounds like we could do a whole deep dive just on derivatives, but for now let's focus on how to actually buy and sell in the market. There are different types of orders you can place, right?
Exactly. Market orders are the most basic. They're filled immediately at the current market price. But let's say you want more control over when you buy or sell. That's where limit orders come in. They let you set a specific price. Your order will only be filled when the market reaches that price.
That sounds pretty smart. And then, of course, we have stop-loss orders,
Yeah.
essential for risk management, right?
Absolutely. A stop-loss order basically sells your shares if the price drops to a certain level. That way you can limit your potential losses.
That's like a safety net.
Exactly.
And there are even more advanced order types, like pre-market limits, iceberg orders, and reload orders. Maybe something to explore as you get more experience.
For sure, those can be valuable tools as your investing knowledge grows.
Now that we've covered the basics, let's explore some strategies that go beyond simply buying and holding.
Sounds good. One of your sources went really deep into stock splits.
Oh yeah, stock splits. Tell me more.
Think of a stock split like slicing a pizza into more pieces. Everyone gets a smaller slice, but the total amount of pizza stays the same. A company divides its existing shares into multiple shares, lowering the price per share. That can make it more appealing to a wider range of investors.
So it's like slicing a pizza. It doesn't change the amount of the company, just how it's divided up. NVIDIA did a stock split recently, and it seems to have attracted more buyers.
Exactly. Now, on the other hand, we have reverse stock splits. It's like taking all those pizza slices and putting them back together. The company consolidates its shares into fewer shares, increasing the price per share.
Why would a company want to do that?
Often it's done to boost the perception of a stock that's declined a lot. But the key thing to remember is that both splits and reverse splits, they might change the price of a share. But the company's overall value stays the same.
So it's not about changing the company's value, just how that value is represented in the market. Makes sense. Now things get interesting with corporate actions like OPAs, public acquisition offers.
Oh yeah, OPAs. Those are basically when a company tries to buy another company. They do this by trying to get enough of the target company's shares. Think of it like a corporate takeover.
Wow, so they're going after the assets, the functions, maybe even office spaces or customer bases.
That can
That can really shake things up.
definitely, these corporate actions can create a lot of opportunities and challenges for investors.
Speaking of market shakeups, let's talk about IPOs and delistings.
IPOs, or initial public offerings, are like a company's grand debut on the stock market. It's when a private company decides to go public. They offer shares to the public for the first time and get listed on a stock exchange.
It's like they're saying, hey, world, come invest with us.
Exactly. IPOs allow companies to raise capital and open up ownership to a wider pool of investors.
But companies can also go the other way with delistings, right? That's when they remove their shares from public exchanges.
Right, and that can happen for various reasons. Mergers, acquisitions, or sometimes a company just decides to go private again.
It's all part of the dynamic nature of the market. And speaking of dynamics, we've got capital expansions and share buybacks.
Capital expansions are when companies issue new shares to raise more money. They might do this to finance growth, invest in new projects, or pay off debt.
So it's like they're inviting more people to the party and asking them to contribute to their growth.
Precisely. Share buybacks, on the other hand, are when a company repurchases its own shares from the market.
Interesting. Why would they do that?
There are a few reasons. It can signal confidence in the company's future, and by reducing the number of outstanding shares, it can boost the stock price.
I see. I imagine there's some strategic considerations with share buybacks as well, especially when it comes to insiders and market perception.
Oh, absolutely. Share buybacks are just one tool a company can use. It's important for investors to understand what these actions might mean.
This brings us to the fun part, the investment strategies. Dollar cost averaging, or DCA, really stood out to me.
DCA is a simple but effective strategy. Instead of trying to time the market perfectly, which is impossible, you invest a fixed amount of money at regular intervals, no matter what the price is doing.
So you're averaging out your purchase price over time. Sounds like a good way to approach the market, especially for beginners.
It's all about consistency and discipline. DCA helps smooth out market volatility and can maximize returns over the long run.
Makes sense. We'll be right back after this to keep our deep dive going.
Welcome back to the deep dive. We're going to keep going with those investment strategies.
Okay, let's do it. The dogs of the DOW strategy really caught my attention. It seems kind of counterintuitive, focusing on the companies that are considered underdogs.
Right. It is a bit unconventional. With the dogs of the DOW, you try to find those 10 stocks, in the Dow Jones Industrial Average, of course, that have the highest dividend yields at the end of each year.
So you're looking for companies that pay out the most in dividends compared to their share price.
Exactly. The idea is that these dogs might actually be really solid companies with strong fundamentals, but maybe they've just been overlooked by the market.
Okay, I see. So you buy these dogs and hold on to them for a year, collect those dividends, and then reassess at the end of the year, see if they're still the top dogs.
Yep, that's the basic idea.
But is there any proof that this actually works?
Well, like any strategy, it's not a guaranteed win. Past performance never guarantees future results.
Right, of course.
But some studies have shown that over time, this approach has actually outperformed the overall market.
So there's some historical backing, but still not a sure thing.
Yeah.
And even with high-yield dividends, diversification is still key, right?
Absolutely. Diversification is always important. You know what they say. Don't put all your eggs in one basket.
Wise words. Speaking of diversification, one of the sources mentioned applying dogs of the DOW to other markets, not just the Dow Jones. Can you give me an example? Like with crypto.
Sure. Instead of dividend yields, you could look at cryptocurrencies with the highest staking rewards, or those with the highest annual percentage yields, those offered through DeFi protocols.
Oh, wow. So you're finding those potentially undervalued assets in a different context? Pretty cool.
It is. It's about adapting those classic strategies to new types of assets, kind of like the can slim method, actually.
Yeah, can slim. It sounds so mysterious, like a secret code for investors. From what I understand, it's all about identifying stocks with high growth potential.
Right. It's about finding those companies that are likely to grow in value. But it does involve a lot of factors.
Yeah, the source mentioned quite a few.
It's a pretty systematic approach,
Mhm.
instead of just going with your gut feeling.
Makes sense.
Can Slim was created by William O'Neill, actually. Each letter stands for a specific criterion: current quarterly earnings, annual earnings growth, new products or services, supply and demand, leader or laggard, institutional sponsorship, and market direction.
Wow, that's a lot. It sounds really data-driven.
It is. It's not about hunches. You use data to find companies that are fundamentally strong and have that potential for growth.
One of the criteria that stood out to me was new products or services. Why is that so important?
Well, it really gets at the heart of innovation. Companies that are developing new things, they're the ones that will stay ahead of the competition.
That's a good point. They're the ones driving that future growth.
Exactly. Think about Apple or Tesla. They've completely changed their industries by coming up with new products, and that's led to massive growth.
So it's not just about finding companies that are doing well now, but also finding those that are setting themselves up for future success.
Exactly. You got to look ahead, anticipate those big changes.
Makes sense.
Now let's talk about dividend investing. It's all about generating income.
Dividends. You mentioned earlier that you're personally drawn to this approach.
I am. While I tend to lean towards growth-oriented investments, I see the value in dividend investing as well. It's about building a portfolio of stocks that pay those regular dividends. It's a steady stream of passive income.
Like getting a regular paycheck from your investments, that can be really appealing.
It is. But you have to remember that dividends aren't guaranteed. A company can change its dividend payments, or even cut them completely if things aren't going well.
So it's not just about picking any stock that pays a dividend.
Yeah.
You need to do your research.
Yeah, it's about finding those companies that have a good track record. They need consistent dividend payments, strong earnings, healthy cash flow, and they have to be committed to rewarding their shareholders over time.
Got it. Now let's move on to a strategy that seems to be about balance and stability, the permanent portfolio.
Ah, yes, the permanent portfolio. It's designed to withstand all sorts of market conditions. It typically allocates investments across 4 key asset classes: stocks, bonds, gold, and cash.
It's like building a financial fortress.
Exactly. The idea is to spread your investments so that if one asset class isn't doing well, the others can make up for it.
I see. So stocks might do well when the economy is strong, but bonds could provide stability during a recession. And gold is often seen as a safe haven during times of uncertainty.
Exactly.
And cash gives you that flexibility.
The permanent portfolio is all about minimizing volatility and getting consistent returns over the long term.
It sounds like a good option for those who prioritize stability.
It can be.
So we've talked about specific strategies, but what are some universal truths for all investors, no matter what path they choose?
Well, one of the most important things is patience. Investing is a marathon, not a sprint. Don't get caught up in the hype or try to get rich quick.
That's good advice for life in general.
It is. Build a solid foundation of knowledge, develop a strategy, and stick to it.
And of course, diversification is paramount.
Absolutely. Don't put all your eggs in one basket. Spread your investments across different asset classes, industries, even geographic regions.
Right, so if one investment doesn't perform well, the others can help balance things out.
Exactly. Diversification helps you manage risk.
Speaking of managing risk, one of your sources mentioned choosing the right platforms, especially with crypto, where new platforms are always popping up.
Yeah, it's important to do your research. Choose platforms that are secure, reliable, and easy to use.
Security is so important.
It is.
Look for platforms that have strong security measures.
Like two-factor authentication and cold storage for crypto.
Those features can really make a difference. And of course, there are always regulatory changes to consider, especially in new markets like crypto.
Right. Staying informed about those regulations is essential.
Knowledge is power, as they say.
Definitely.
We're going to take a quick break, but we'll be back soon to wrap up our deep dive. Welcome back to the Deep Dive. We've covered a ton of ground already, but I want to make sure we touch on some practical tips and resources, things that can actually help you on your investing journey.
Yeah, good idea. Sometimes even seasoned investors forget the basics, like the power of compounding, for example.
Compounding. I've heard it called magic, and I think that's a pretty accurate description.
Yeah. It really is like magic. It's the idea that you're earning returns not just on your initial investment, but on your returns as well. It just keeps growing and growing.
Like a snowball effect.
Exactly. The longer you stay invested, the more potential your money has to grow exponentially.
It really highlights the importance of starting early, even if it's with a small amount.
Absolutely. Time is your best friend when it comes to investing.
Speaking of getting started, what are some resources for people who want to learn more? You mentioned some community spaces earlier.
Right, several of the sources highlighted online communities, specifically a Discord server and a Telegram channel. They're all about sharing investing insights and encouraging discussions among investors.
That sounds amazing, especially for beginners. Having a community where you can ask questions, get feedback, learn from others' experiences.
It can be incredibly valuable. These communities offer all sorts of resources, educational content, real-time market discussions, and even insights from experienced traders.
That's a great way to expand your knowledge and connect with other investors.
It ties into what you were saying before about ongoing learning. The market's always changing, so you got to keep up.
Absolutely. Never stop learning. Read books, listen to podcasts, attend webinars, engage with those online communities.
Right. The more you know, the better decisions you'll make. And speaking of decisions, let's not forget about risk management. It's a crucial part of any investment strategy.
Absolutely. It's not about avoiding risk altogether. It's about managing it wisely.
And one of the most basic ways to manage risk is diversification, right?
Exactly. Diversification is key. It means spreading your investments across different asset classes, industries, maybe even different parts of the world.
Don't put all your eggs in one basket.
Right.
So if one investment takes a hit, the others can help cushion the blow.
Exactly. Diversification can really smooth out the ups and downs of the market.
But what about managing risk on a more individual level, like for specific investments?
Well, one of the best things you can do is set appropriate position sizes.
Position sizes. It's about deciding how much capital you're willing to risk on each trade or investment. By spreading your bets, you're making sure that no single investment can wipe you out.
Makes sense. It's like not putting all your eggs in one basket, but on a smaller scale.
Exactly.
And of course, there are stop-loss orders. Those are designed to limit your losses, right?
That's right. A stop-loss order automatically sells your shares if the price drops to a certain level. It's like an insurance policy for your investments.
It helps take the emotion out of trading, especially when things get volatile.
Absolutely. Emotions can really mess with your investment decisions.
Fear and greed can be powerful forces.
They can. Fear might make you sell at the worst possible time. And greed can lead you to chase risky investments without doing your research.
So how can we avoid making emotional decisions?
Discipline is key. Have a plan and stick to it. Don't let your emotions dictate your actions.
Right. Your investment decisions should be based on logic, your goals, and your risk tolerance, not on how you're feeling at any given moment. It seems like having the right mindset is just as important as having the right knowledge.
It is.
And in this ever-changing world of finance, knowledge is power.
Absolutely. Stay informed, be adaptable, never stop learning.
It's all part of the journey. Well, it looks like we've reached the end of our deep dive into the stock market. We've learned so much about how it works, explored different strategies, and gained some valuable insights.
It's been a great exploration. Hopefully you're feeling inspired to start your own investment journey.
Remember, investing is a marathon, not a sprint. Be patient, do your research, and most importantly, enjoy the ride.
Happy investing.
And until next time, keep diving deep.